Money in the U.S. Stock exchanges. Stock exchanges enable companies to raise money, increase their profiles, and obtain market valuation. The main exchanges in the U.S. are the New York Stock Exchange, NASDAQ, and NYSE MKT and NYSE Amex options. New York Stock Exchange. The center of the U.S. financial world is the New York Stock Exchange, NYSE, on Wall Street in New York City. It is the world's largest stock exchange in terms of market capitalization, which is the market value of the company shares traded on the exchange. The market capitalization of the NYSE was listed at $19.3 trillion as of June 2016. The average daily trading value in 2013 was $169 trillion. The NYSE, called the Big Board, lists close to 1,900 companies, of which about 400 are outside the U.S. It is owned by Intercontinental Exchange, a U.S. holding company. The NYSE is an auction market where brokers buy and sell securities on behalf of investors. The goal is to match the highest bidding price to the lowest selling price. In addition, the NYSE sells securities such as options, mutual funds, bonds, derivatives, exchange-traded funds, EFTs, warrants, commodities, and U.S. Treasury bonds. There are two major markets to consider, the primary market and the secondary market. Primary market. In the primary market, companies sell new issues of common and preferred stocks, also called an initial public offering, IPO, as well as notes, government bonds, corporate bonds, and bills. This facilitates funding for business expansions and is usually done through investment banks or securities dealers, which set the price for the IPO and administer the sale. Trading then takes place on the secondary market. Secondary market. Most sales occur on the secondary market, which is so named because it's where investors buy and sell securities they already own. The sale is the second transaction the security has gone through. Secondary markets operate as marketplaces that compete with each other. Each secondary market has its own requirements for listing on the exchange. A company can appear on more than one exchange. NYSE. To be listed on the NYSE, a company must meet certain standards. The application includes details such as articles of incorporation, bylaws, confirmation that shareholder requirements are met, and information about key executives. A security underwriter confirms that the company meets the standards for listing. In addition, a company must have a combined pre-tax income for the last 3 years of at least $10 million and earned at least $2 million in the previous 2 years, or have earned $12 million in pre-tax dollars in the past 3 years with at least $5 million in the most recent year and $2 million in the year before that. At least 400 shareholders need to own more than 100 shares of stock each. There must be 1.1 million publicly held shares, and a market value of the public shares must be at least $40 million, with stock trading for at least $4 per share. NASDAQ. Unlike the NYSE, the NASDAQ, National Association of Securities Dealers Automated Quotation System, has a virtual presence only. It operates via a telecommunications network for listing and trading securities. The NYSE operates on an auction system, but the NASDAQ utilizes dealers or market makers. The NASDAQ is known for attracting firms in the high-tech industry. An estimated 3,100 companies are listed on the exchange. About 2 billion shares are traded daily, and, among the U.S. exchanges, it handles the most IPOs. To apply to be on the list, a company must have a minimum of 1,250,000 publicly traded shares and the bid price of at least $4 per share. Other requirements include a minimum of 2,200 total shareholders, or 550 total shareholders with 1.1 million average trading volume over the past year. The pre-tax earnings requirement is a combined $11 million for the past 3 years, with $2.2 million in earnings for the prior 2 years. Over the last 12 months, the average market capitalization must be $550 million, with at least 1.1 million in trading volume. There cannot be a net loss in the previous 3 years, and aggregate cash flow, revenues, and operating income standards must be met. NYSE MKT and NYSE Amex options, formerly known as the American Stock Exchange, Amex. The NYSE united with Amex in 2008. Both the NYSE MKT and NYSE Amex options are owned by Intercontinental Exchange. The Amex market was renamed NYSE MKT in 2012. It was created with young, high-growth companies in mind. Companies listed on the NYSE MKT benefit from using the NYSE's fully integrated platform. This union enhanced the NYSE's role in exchange-traded funds, ETFs, cash equities, options, and more. Other exchanges. Other exchanges include the Philadelphia Stock Exchange, PHLX, Chicago Stock Exchange, CHX, International Securities Exchange, ISC, National Stock Exchange, NSX, and the Boston Stock Exchange, BSE. In Canada, the Toronto Stock Exchange, TSX, is the largest exchange market in Canada. It is overseen by the Ontario Securities Commission. There is also the Canadian Securities Exchange, CSE, as well as stock markets in Vancouver and Montreal. Valuation and regulation. Stock indexes attempt to measure the values of a section of the stock market. Indexes are tools used by financial managers and investors. NASDAQ Composite. The NASDAQ Composite is an index of the securities listed on the exchange. Standard & Poor's 500, S&P. The S&P is comprised of the top 500 companies that are listed on either the NYSE or the NASDAQ. They are the largest companies based on market capitalization. Dow Jones Industrial Average, DJIA. The DJIA includes the 30 largest and most influential companies in the U.S. The companies are considered to have blue-chip stocks. They are very large corporations with good reputations. With only 30 companies included in the index, the DJIA isn't considered an indicator for the entire market, but the companies are considered stable and offer the possibility of dividends as well as less risk for an investor. The Securities and Exchange Commission, SEC. The SEC is designed to protect investors and to maintain orderly and efficient markets. Public companies are required to disclose financial information to the public. The goal is to give investors accurate data so they have what they need to make investment decisions. The SEC oversees the securities exchanges, brokers, dealers, funds, and investment advisors to push transparency for the public. The SEC is authorized to bring action to companies and individuals who break the laws. For example, insider trading, deceptive information about securities, and accounting fraud. Banking regulations. Some complaints don't involve securities, so the Federal Reserve System, the Fed, responds to problems with banks and other types of financial institutions. Other federal regulatory agencies include the OCC, FDIC, and the FASB. The Fed and the CFPB. The Fed investigates claims made by individuals who have been treated unfairly. Complaints can be filed on the Fed's website or by phone, mail, or fax. The Consumer Financial Protection Bureau, CFPB, is an independent agency funded by the U.S. Federal Reserve. The CFPB was created to protect consumers from deceptive and unfair treatment practiced by financial institutions, including banks, payday lenders, credit unions, mortgage lenders, and debt collectors. OCC. The Office of the Comptroller of the Currency, OCC, is an independent bureau that operates within the U.S. Department of Treasury. The OCC has the ability to charter, supervise, and regulate national banks and federal savings associations, and branches and agencies of foreign banks. The mission of the OCC is to make sure that banks treat all customers fairly and that they comply with applicable laws and regulations. Individual state regulators. Each state has a government agency that regulates state-chartered banks, trust companies, and credit unions. These agencies often also monitor and regulate state business by insurance companies, bail bond agents, mortgage bankers, and more. FDIC. The Federal Deposit Insurance Corporation, FDIC, encourages public confidence in the U.S. financial system by insuring some bank deposits up to $250,000. The FDIC insures a variety of savings accounts, including certain retirement accounts, joint accounts, employee benefit plan accounts, and revocable and irrevocable trust accounts. Consumers with FDIC-insured banks are protected in case of a bank failure. FASB. The Financial Accounting Standards Board, FASB, establishes the standards for financial reporting in the U.S. FASB standards are known as Generally Accepted Accounting Principles, or GAAP. The standards are created to ensure accurate and acceptable accounting practices by corporations, which provide transparent information for investors. The standards help prevent accounting fraud. In Canada, OSFI, the Office of the Superintendent of Financial Institutions, OSFI, is an independent agency that reports to Parliament via the Minister of Finance. The OSFI regulates financial institutions and private pensions subject to federal oversight. FRAS. The Financial Reporting and Assurance Standards, FRAS, is the Canadian version of the U.S.'s Financial Accounting Standards Board. As in the U.S., the organization's purpose is to establish standards on accounting and auditing to protect the public interest. OCA. The Office of Consumer Affairs, OCA, protects the interests of Canadian consumers and provides valuable information to help educate consumers about credit cards, debt, credit scores, collection agencies, and more. Companies. A company doing business in the U.S. must register its business name to comply with the law. Types of companies. The filing procedure to register a business name varies by state, although forms are usually filed with the state's Secretary of State. Businesses can register as a corporation, LLC, or other partnership, S-corporation, or sole proprietorship. If a business is under the owner's name, registering a trade name is not required, but is advisable. Some sole proprietors set up an LLC, corporation, or partnership due to the legal protections these offer. All businesses must get an IRS Federal Employee Identification Number, FEIN. The EIN is used for financial purposes, such as filing tax returns and applying for business licenses. The accounting year. The IRS has an accounting and tax filing calendar for businesses and the self-employed. Estimated taxes are filed quarterly. International businesses that operate under the Foreign Account Tax Compliance Act, FACTA, must also meet IRS tax requirements. Most businesses use the calendar year for accounting and tax purposes. The year runs from January 1st through December 31st. Businesses using a year-end date that isn't December 31st follow a fiscal year. To use a fiscal year, the business needs IRS approval. Large corporations have flexibility when choosing their calendar year, and the taxes required on income differ by the type of corporation. For instance, an S-corporation doesn't pay corporate income tax. The income and expenses are passed through to the shareholders as dividends, which are taxable. A short tax year is another accounting year. It applies to businesses operating for less than a year. Calendar and resources. The U.S. federal corporate tax rate is 35%, but there's an additional state and municipal corporate tax rate that varies by state and that pushes up the rate to about 39%. Branch profit tax adds an additional 30% tax on foreign corporations engaged in U.S. business or trade. Federal due dates for estimated corporate taxes. March the 15th. Action. File from 11/20 and pay taxes due. April 18th. Action. Deposit first installment of estimated income tax for the year. June 15. Action. Deposit second installment of estimated income tax for the year. September 15th. Action. Deposit third installment of estimated income tax for the year. December 15th. Action. Deposit fourth installment of estimated income tax for the year. Due dates, timing, and required forms differ, depending on the type of business entity. These also vary for fiscal year taxpayers. Forms required for each type of business entity can be found on the IRS website, www.irs.gov. Find filing requirements and rules of regulation by state on the Small Business Association's website, www.sbs.gov. The U.S. tax system. Money the government receives in federal income taxes comes from three main sources: individual income taxes, payroll taxes, and corporate taxes. Other revenue sources include estate tax, excise taxes, and other fees and taxes. Revenue from U.S. taxes. In 2015, the federal government spent $37 trillion on services for the public. These services include Medicare and Medicaid programs, infrastructure improvements, and Social Security benefits. According to the Office of Management and Budget, 47% of the 2015 revenue came from individual income tax. Payroll tax was next at 33%, and corporate income tax came in at 11%. The remaining revenue, 9%, was from excise and other taxes. Other revenue sources are profits on assets that are held by the Federal Reserve, regulatory fees, and custom duties. Policies used to deal with the Great Recession of 2008 are one reason the share of revenue from individual income taxes and payroll taxes is so high. Payroll tax. Payroll taxes are paid by corporations and by individuals. They are calculated based on a percentage of an employee's income. Employers collect several types of taxes. Federal taxes are collected by employers from employees' paychecks. Employees must also pay part of their income for Social Security taxes and Medicare. For 2016, the Social Security tax rate was 6.2% each for the employer and employee, 12.4% total. This tax is capped once the employee's wages reach $118,500. The Medicare tax rate is 1.45% for both employer and employee, 2.9% total. Self-employed individuals must pay a self-employment tax, a Social Security/Medicare tax for the self-employed, as well as income tax. Self-employed individuals must file annual returns, but also pay estimated quarterly taxes. Excise tax. The U.S. does not impose a value-added tax, VAT, but does levy excise tax on some products. Excise taxes are paid when purchases are made. Revenue from highway-related excise tax made up 38% of excise tax revenue in 2014. Revenue from gasoline and diesel taxes make up 90% of the Highway Trust Fund revenue. The second largest amount of excise revenue comes from tobacco taxes, $15.6 billion in 2014. Tobacco tax is collected by the U.S. Treasury Department. The tax for other goods is collected by the Internal Revenue Service, IRS. Aviation, alcohol, and healthcare, Affordable Care Act, or ACA, also have excise taxes. Capital gains tax. A capital gain is realized when an asset is sold for more than an individual or a corporation paid for it. This type of profit is common with investments and property. There are two types of capital gains. Short-term capital gains are from assets held for a year or less and are taxed at the same rate as income. Long-term capital gains are from assets that were held longer than a year. The tax rate on a net capital gain, the gain minus capital losses, depends on income. The maximum tax rate is usually 20%. However, for high-income taxpayers and for certain types of net capital gains, the tax can be up to 28%. State taxes. Some states levy tax on income and impose other taxes, such as sales tax. As of 2016, 43 states collected income tax, 7 did not. 41 states tax wage and salary income. 2 tax dividend and interest income only. Individual income tax is one of the biggest sources of revenue for most states. Tax rates vary wildly among states. Florida has no income tax, but California has a 13.3% income tax rate. Differences exist in other taxes, such as sales taxes that are collected by states. 5 states do not impose any statewide sales tax: Alaska, Delaware, Montana, New Hampshire, and Oregon. However, Montana and Alaska do let sales tax be charged at the local level. 45 states collect statewide sales taxes and 38 states impose only local sales taxes. The 5 states with the highest average combined state-local sales tax rates are Tennessee, 9.45%, Arkansas, 9.26%, Alabama, 8.91%, Louisiana, 8.91%, and Washington, 8.89%. It is essential to understand how the tax system works in the state where a person lives. Differences occur not only in what type of tax is collected, but also at what level, state versus local, the tax is levied. State governments use the tax collected to meet the needs of that state. The 50 states and the District of Columbia spent $1.1 trillion in state revenues in fiscal year 2013, according to the most recent survey by the National Association of State Budget Officers, NASBO. For most states, the largest areas of spending is education, K-12 education, Medicaid, and children's health programs. Other areas include higher education, transportation, corrections, and public assistance. In Canada, the Canada Revenue Agency is the Canadian version of the IRS. Taxes are levied at the federal, provincial, and municipal levels. Common taxes include sales tax, property tax, business tax, and income tax. The federal income tax rates for Canadians in 2016 was 15% on the first $45,282 of taxable income and up to 33% of taxable income over $200,000. Some indirect taxes paid by Canadians include Goods and Services Tax, GST, the Harmonized Sales Tax, HST, systems, and Provincial Sales Tax, PSTs. Government spending. Medicare, Medicaid, CHIP, etc., 25%. Social Security, 24%. Defense, 16%. Safety net programs, 10%. Benefits for federal retirees and veterans, 8%. Interest on debt, 6%. All others, 3%. Education, 3%. Infrastructure, 2%. Science and medical research, 2%. Non-security international, 1%. Revenue received by the government through taxation funds public spending. Most revenue goes to meeting Social Security obligations, social welfare programs, and public sector pensions. Defense spending makes up 16% of the budget. Sources of excise tax revenue in 2014. Highway, 38%. Tobacco, 17%. Aviation, 14%. ACA, 14%. Alcohol, 11%. Other, 6%. The government debt market. When a country spends more money than it takes in, the result is a budget deficit, which creates national debt. Sometimes the U.S. national debt is referred to as the deficit, although debt and deficit are not the same thing. The national debt. The national debt is the result of the U.S. government borrowing money to cover years of operating with a budget deficit. Where there is a deficit, the U.S. has to borrow the money by selling Treasury securities to the public. For instance, selling savings bonds and Treasury bills. All of this becomes part of the debt. The national debt in early October 2016 was over $19.5 trillion. The debt grows larger every second due to the interest owed. The interest paid on the debt in 2015 was $402 billion. Handling a budget this way is similar to a consumer charging items to a credit card, and when the bill comes due, borrowing to pay part of the balance. Now, they have a balance and loan accruing interest. The national debt does impact consumers. It increases the cost of living and slows the economy. Issuing Treasury securities is one way to produce a revenue stream that can be used to fund budget deficits, specific projects, unemployment benefits, or whatever is needed at the time. Government securities. A government security is a bond that is issued by the government. There is a promise of repayment when the bond matures. Examples of other securities are Treasury bills, Treasury bonds, and savings bonds. U.S. savings bonds are appealing to some because they have a fixed but low interest rate for a period of time. But they must also be held for a minimum of 12 months. Savings bonds can be redeemed, return of the investor's principal in a fixed income security, after the 12-month period. However, redeeming the bond during the first 5 years results in a 3-month interest penalty. There are 2 different types of savings bonds, Series EE and Series I bonds. The Series EE bonds pay a fixed rate. The Series I bonds earn interest from a combination of semi-annual inflation rate and a fixed rate. Rates for savings bonds are set on May 1st and November 1st each year. As of May 2nd, 2016, Series EE bonds earn an annual fixed rate of 0.10%. The Series I bond earns a composite rate of 0.26%. A portion is indexed to inflation every 6 months. Both types have an interest-bearing life of 30 years. Clearly, no one gets wealthy by investing in savings bonds, but they used to be a popular gift. This is one way the government borrows money from the public. The government also issues many other types of securities, including Treasury bonds, T-bonds, Treasury bills, T-bills, and Treasury notes, T-notes. T-bonds mature in 10 to 30 years. T-notes are called intermediate-term bonds because they mature between 1 year and 10 years, but not more than 10 years from the issue date. T-bills have maturities of less than a year. Treasury bonds and notes pay a fixed rate of interest semi-annually. Floating rate notes, FRNs, and TIPS. A Treasury FRN has a price that is determined by auction. They have a term of 2 years and they can be bought in multiples of $100. An FRN has an interest rate that floats over the life of the security. The rate is the sum of an index rate and a spread. FRNs are indexed to the highest accepted discount margin of the most recent 13 weeks Treasury bill. The spread will stay the same until maturity. Interest rate is applied to the par amount of the FRN every day. Interest is paid quarterly. Treasury inflation-protected securities, TIPS, are slightly different securities. The principal amount is adjusted by the changes in Consumer Price Index. TIPS do pay interest at a fixed rate, but the amount of the interest payment will vary from month to month. If inflation is involved, the investor gets a bigger interest payment. But if the opposite happens, deflation, the investor's interest payment goes down. The interest rate is set by an auction, and TIPS are issued at 5, 10, and 30 years. It's possible to bid for TIPS via a Treasury Direct account. There are 2 types of bids, non-competitive and competitive. With a non-competitive bid, the investor must accept the rate that's determined at auction. With a competitive bid, the investor is the one who decides what the yield must be. A competitive bid requires the use of a bank or broker. Municipal bonds. There are investment opportunities at the state government level too. Municipal bonds, called munis, are debt securities issued by state governments and local governments, such as cities and counties that need to sell bonds for funds. A benefit for the investor who buys munis is that the interest is exempt from federal income tax. The bondholder is repaid the principal amount of the bond plus interest covering a specified number of years. 2 types of munis are commonly bought, general obligation bonds and revenue bonds. General obligation bonds are not secured by assets. The investor relies on the reputation and credibility, referred to as full faith and credit, of the issuer to repay the debt. These bonds are issued by states, cities, and counties. The issuer has the power to impose a tax, if necessary, to pay back the public. Revenue bonds are backed by the revenues that come from a specific project or source, such as a local stadium, highway tolls, or even a hospital. Revenue bonds are riskier, so interest rates are higher. Public finance resources. Internal Revenue Service, IRS. Filing income taxes to the IRS can be done online, by mail, by using commercial tax software, or by a tax preparing service, www.irs.gov. The IRS website has current information about excise taxes and what forms to file. www.irs.gov/businesses/self-employed/excise-tax. State taxes. For information about state income taxes and filing options by state, visit the Federation of Tax Administrators, FTA, www.taxadmin.org/state-tax-forms. National debt. The Office of Management and Budget, OMB, assists the President in meeting budget, policy, and regulatory objectives. www.whitehouse.gov/OMB. To track the U.S. debt, visit www.usdebtclock.org. To bid for tips via a Treasury Direct account, www.treasurydirect.gov/indiv/myaccount_treasurydirect.htm. The Federal Reserve Bank. The Fed's goal is to keep the economy of the U.S. stable and secure. It also offers valuable information for consumers to help them understand personal finance. www.federalreserve.gov. Spending and interest on federal debt in 2015. Discretionary spending, $1.1 trillion, 29.34%. Interest on the debt, $229.15 billion, 6.03%. Mandatory spending, $2.45 trillion, 64.63%. Federal Reserve. The Federal Reserve System was established as the U.S. Central Bank by Congress on December 13, 1913. Signed into law by President Woodrow Wilson, the Federal Reserve Act was a response to a period of financial instability and panic. The Fed and the U.S. economy. The Federal Reserve Act produced a decentralized bank that could also handle the competing interests of popular sentiment and financial institutions and banks. The Federal Reserve Bank, the Fed, uses policy to subtly impact economic conditions. In 1929, the market crashed and the U.S. plunged into what would be known as the Great Depression. During the next few years, 10,000 banks failed. The Fed was criticized for not taking action to avert the crash. This event led to Congress passing the Glass-Steagall Act in 1933. This law requires a separation of commercial banks and investment banks. It also required that government securities would be used as collateral for Federal Reserve notes. The Glass-Steagall Act also created the Federal Deposit Insurance Corporation, FDIC, which insures bank deposits up to a certain amount. In 2016, that amount is $250,000 per single account. For joint accounts, it's $250,000 for each owner. Another major piece of legislation is the Full Employment and Balanced Growth Act, which is often referred to as the Humphreys-Hawkins Full Employment Act. It was signed by President Jimmy Carter on October 27, 1978. Part of this legislation mandates that the Fed must pursue a monetary policy that encourages long-term growth and controls inflation. If this is done well, it promotes maximum employment and stable prices. Role of the Fed. The Fed has four primary roles: regulating banks and financial institutions, using monetary policy to prevent an unstable economy and unstable financial markets, using policy to influence the credit environment, employment numbers, and price and money, and providing the U.S. government with certain financial services. Interest rates. The Fed also has another important role. It sets what's called the federal funds rate and the discount rate. The federal funds rate is the rate in which banks can lend money to each other overnight. The Fed can affect this rate by lowering the discount rate, or the interest rate charged by the Fed, below the federal funds rate. This makes banks want to borrow from the Fed as opposed to other banks due to the lower rate. Thus, it puts pressure on banks to lower their overnight rates. The law requires banks to also have a reserve amount at all times. Since the banks don't earn interest on their own reserves, they like to lend the money to other banks and earn some interest. The current interest rate set by the Fed for banks to borrow money from each other is 0.5%. If the Fed decides to increase the rate, it's passed on to consumers and it makes borrowing money more expensive. If the Fed lowers the rate, it makes borrowing less expensive, and so more consumers borrow money. The prime rate, which is of interest to consumers, is published by the Wall Street Journal every day. This rate is the index used by credit card companies, for instance, to set APRs for their credit card products. It's also the benchmark for loan companies, lines of credit, home equity loans, and more. Changes in the federal funds rate impact the prime rate. The current prime rate is 3.50. A credit card issuer will use 3.5% as the base rate and add a range to that. The APR might be 3.5% plus 10.5% or 14%. If the prime rate goes up, prodded by the increase in the federal funds rate, then the 14% APR will increase by the same amount. The money supply. The U.S. Treasury is responsible for the actual printing of money, but it's the Fed that is in charge of the money supply. To increase the money supply, the Fed might change the reserve amount that banks must have on hand. If the reserve amount is lowered, banks can lend out more money. The Fed can also change interest rates. If the discount rate is lowered, then it lowers the cost of borrowing and increases economic activity. But this move could also lead to inflation, so it is done carefully and with great thought. Another way to increase the money supply in the economy is to conduct open market operations. This action impacts the federal funds rate. Simply put, to increase the money supply, the Fed buys government bonds. The Fed might want to decrease the money supply. If so, then it does the opposite of what's required to increase the money supply. One way for the Fed to decrease the money supply is to change the reserve amount that banks must have on hand. If the reserve amount is increased, banks are forced to decrease lending. Again, the Fed could also change interest rates. If the discount rate is raised, then it decreases the money supply and dampens economic activity. Fed activities. Quantitative easing. Sometimes a policy called quantitative easing, QE, is used to influence interest rates. The Fed buys government securities, a bond buying program, from the market to try and lower interest rates and increase the money supply. This, in turn, can lead to a more robust economy as consumers find cheaper credit and start borrowing again. This action is considered unconventional, and it's used when more conventional methods haven't stimulated the economy. Since the 2008 recession, the Fed has used a QE policy more frequently than in the past. After 9/11. On September 11, 2001, terrorists attacked New York City, Washington, D.C., and Pennsylvania, killing many Americans. This tragic event also disrupted the financial markets. The Fed took action to contain the damage and prevent further market instability during a difficult time in American history. Some of the actions included lowering interest rates and loaning billions to financial institutions. Within a few weeks, the U.S. economy had stabilized from the attacks. The Fed played a big role in helping America maintain an even footing during a frightening and unpredictable time. Mortgages. The United States has one of the most diverse and innovative mortgage markets in the world, offering a wider range of products and lenders than are available in most countries. Mortgages. There are many different types of mortgage lenders in the U.S., from banks to credit unions to non-bank lenders, such as Quicken Loans. Competition is fierce, which helps to stabilize rates for consumers. Although a vast number of lenders operate in the U.S., a few dominate the industry. During the fourth quarter of 2015, Wells Fargo originated twice as many mortgages as Chase, according to Mortgage Daily, an industry publication. Wells Fargo totaled $47 billion in organizations, and Chase originated $23 billion. As of June 30, 2016, the total mortgage balances on consumer credit reports was $8.36 trillion, according to the Federal Reserve Bank of New York's Household Debt and Credit Report. Several types of mortgages are available in the U.S. Deciding between a fixed and adjustable rate mortgage is one of the first decisions a borrower has to make. With a fixed rate, which is the most common choice, the interest stays the same for the entire repayment of the loan. Most fixed mortgages are either for 30 or 15 years. Many borrowers opt for the 30-year fixed mortgage to secure a lower monthly payment. An adjustable rate mortgage, ARM, has an interest rate that adjusts over the period of the loan. With a hybrid ARM, the rate is usually fixed for a certain number of years and then it is subject to change. There are also government-insured loans such as FHA loans, VA loans, and USDA/RHS loans, which are programs for income-eligible buyers in rural areas. Mortgages eligibility. Lenders consider many factors when determining the eligibility of buyers. One of the requirements for a mortgage is an acceptable credit score. The credit score required for approval of a mortgage varies among lenders. With a FICO score that is 720 or higher, the buyer gets the most favorable rates and terms. But, according to the Federal Deposit Insurance Corporation, FDIC, if the score is below 660 or down to 620 if the economy is good, the buyer is considered a subprime customer. Subprime borrowers can still get mortgages, but the rates and fees are higher. But a borrower also needs a favorable loan-to-value ratio, LTV, which shows how much the property is worth compared to the amount you need to borrow. The more favorable the ratio, the better. It is also best to have the down payment, preferably around 20%, on hand before applying for a mortgage. Knowing the down payment helps buyers determine how expensive a house they can afford. Once the mortgage shopping has begun, pre-approvals are necessary. This is when the lender will look at the borrower's credit report and check the credit score. While this does result in a hard inquiry on the credit report, the good news is that the FICO score, the score used most often by lenders, recognizes inquiries that are the result of mortgage rate shopping and treats multiple rate inquiries as only one inquiry that impacts the score. Another test for eligibility is the debt-to-income ratio. Mortgage lenders like to see a debt-to-income ratio of less than 36% of the buyer's gross monthly income. Mortgage payments will be higher, though, when taxes and property insurance are added. Lenders also take into account the employment history of borrowers. A stable history is considered to be positive. Those who are self-employed may need to provide tax returns or bank statements to show they have a stable financial situation. Mortgage trends. The housing market has improved to the point where new home sales have hit their highest levels since April 2008. In 2008, the housing market, as well as the U.S. economy, went into a downward spiral. In the mid-2000s, many subprime mortgages had been approved, and this contributed to the mortgage crisis. The housing market is now rebounding, and this encourages home sales. The best selling time is the spring and the summer, because it allows families to get settled into a new home before the start of the school year. Currently, down payments range from 0, unlikely but not impossible, to about 20%. Most lenders require at least 3%, and FHA loans require at least 3.5%. Long-term mortgage rates were around 3.42% at the end of 2016, according to the big mortgage lender, Freddie Mac. The 15-year mortgage, which is popular with refinancers, was at 2.81%. Mortgage assistance. Government programs for mortgage assistance. Several programs designed to help homeowners are available. Here's an overview, and for more details, go to the Making Home Affordable website, www.makinghomeaffordable.gov. Home Affordable Modification Program, HAMP, helps those who need lower monthly payments so they continue to pay their mortgage in the long term. Home Affordable Refinance Program, HARP, assists those who are current on their mortgages but have had difficulty refinancing the loan. Home Affordable Foreclosure Alternatives Program, HAFA, advises homeowners who need to exit their homes and be relieved of their remaining mortgage debt, either via a short sale or a deed in lieu of foreclosure, DIL. HAFA provides $10,000 for relocation expenses. Home Affordable Unemployment Program, UP. This program reduces or even suspends monthly mortgage payments for job hunters. Federal Housing Administration Short Refinance for borrowers with negative equity. FHA Short Refinance. For those who are up to date on payments but owe more than their home is worth. Called an underwater mortgage. Hardest Hit Fund Programs, HHF. These programs in 18 states and the District of Columbia were designed to help homeowners who have issues such as unemployment, inability to pay mortgages, and finding a new affordable home to move to. Program details vary by state. Credit cards. The U.S. has a highly developed credit card market, with more than 1 billion credit cards in use. The credit card market has, however, gone through major changes in recent years. Credit debt. In 2000, there were 1.4 billion credit cards in circulation. Fast forward 12 years to 2012, and there were 1.17 billion credit cards in circulation, according to data from the U.S. Census Bureau. The number of credit cards decreased during the recession years, which occurred around 2008 to 2010. Today, issuers are pickier about who they approve for a card, and many young adults are postponing the use of credit. The average credit card debt per household is $9,600. In 2009, during the recession, 44% of Americans were carrying a balance. In 2014, the proportion of Americans carrying a balance was down to 34%. Those who carry a balance pay interest on their balances. This compound interest can increase the debt on the card quickly. Calculating interest. Interest on accounts that are not paid in full can be calculated in a few different ways. The most commonly used methods are average daily balance and daily balance. With average daily balance, the interest charged depends on whether the credit card company adds in new purchases or excludes them. With daily balance, the company charges interest for each day's balance and then adds it together to get the total finance charge. Credit card companies don't start charging interest on credit cards as soon as a purchase is made unless the card is already carrying a balance. There's an interest-free grace period between 21 and 25 days, which is the time between the purchase date and the payment due date. This offers consumers an interest-free period, but this is only applicable if the balance of each payment cycle starts at zero. Credit Card Act. The Credit Card Act of 2009 offered significant new consumer protections. Credit card issuers were no longer permitted to do many activities, including the following: suddenly raise annual percentage rates, APRs, without a 45-day notification. Inflict retroactive rate increases on an outstanding balance, except under certain circumstances. Charge special fees on subprime cards, and give away freebies on college campuses. The CARD Act helps to protect college students by prohibiting issuers from giving credit cards to anyone under 21 unless they have the income to pay back any debt. Issuers are no longer allowed to set up tents on campuses and give away incentives to get students to sign up for cards. The Act also made the terms and conditions for credit cards more transparent. Consumers received clearer due dates than before, explanations for changes to the terms, and the right to have high-interest balances paid first. Retirement. Preparing for the golden years can be complex. Most Americans find that they need their own retirement funds to supplement the amount they receive in Social Security benefits. Social Security. Americans pay a special tax on their income under the Federal Insurance Contributions Act, FICA. Also referred to as the Social Security tax, it is used to fund U.S. social programs. Included is a hospital insurance tax, which is also known as the Medicare tax. There's a limit on the amount of earnings subject to FICA taxes. In 2016, the limit is $118,500. So income exceeding that amount is not subject to FICA. So for the year 2016, the Social Security tax rate was 6.2% on the first $118,500 of earned income. The Medicare tax rate is 1.45% on the first $200,000 and 2.35% above $200,000. Social Security benefits are based on the total of your past earnings. The exact amount you'll get every month when you're eligible is calculated based on a formula that uses the Average Indexed Monthly Earnings, AIME. The formula favors people with lower incomes. The Social Security system also calculates your benefit based on the age you start receiving money from the system. The longer you work, the more likely you are to have a higher monthly benefit. Benefits are also adjusted for inflation. A divorced spouse might qualify for survivor benefits if the marriage lasted at least 10 years. but there are other conditions that must be met. For example, the surviving spouse must be unmarried and be 60 years old for survivor benefits and at least 62 for spousal benefits. It's possible to track your Social Security benefits online. Having access to the amount of your benefit can help you plan how much income will be needed from additional sources when you're older. IRA and Roth IRA. Some people set up an individual retirement account, IRA. An IRA is an excellent investment in the future. There are two major types of IRAs, traditional IRAs and Roth IRAs. Contributions to traditional IRAs are taxed when you withdraw the funds, ideally after retirement. If money is withdrawn before the age of 59 and a half, there might be an additional 10% tax to pay. The point is that your future earnings will be lower than they were when you were in the prime of life and working many hours, so earnings will be taxed at a lower rate in the future. There are limitations to the amount of contributions that can be made each year. Contributions to a Roth IRA are made after taxes are paid, but once your contributions are in the fund, the interest or investment earnings are tax-free when you retire. To set up a Roth IRA, your income must not exceed the amount that is set by the IRS. This limit depends on how you're filing as well as other factors. For more details, go to www.rothira-Roth-IRA-eligibility. 401k. Another type of retirement plan is a 401k. Taxes on contributions are not paid until it's later withdrawn. These plans are sponsored by employers, who sometimes match the employee's contribution as a company benefit. With a 401k, the employee controls how the money is invested. There are limits to what you can contribute. In 2016, for those under 50, the maximum contribution to the 401k was $18,000. For those over 50, an additional $6,000, up to $24,000, was allowed. Taxes and investments. Any U.S. resident who earns interest on a savings account or investments in other financial products is subject to tax on income received from these activities. With some retirement accounts, such as IRAs, the interest is tax deferred. Tax savings and investments. Savings accounts, in general, have low returns right now, but the amount is still taxable. This requires submitting a 1099 INT form to the IRS. Interest income is taxed at marginal rates, which means your interest income is taxed at your personal income tax rate. Examples of interest taxed as ordinary income include interest on deposit accounts, such as checking and savings accounts, the value of gifts received for opening an account, dividends on deposit or share accounts in cooperative banks, credit unions, and other banking associations, interest on certificates of deposit, CDs, and interest on insurance dividends. Different rules apply to dependents' accounts. Federal filing is required in the following cases. The dependent has unearned income of more than $1,000 or has earned income of more than $6,200. Gross income total is also a factor. If the dependent's gross income total was more than $1,000 or the dependent had earned income up to $5,850 plus $350. Parents can give a child up to $14,000 gift before taxes must be paid. The gift tax is complex and might need to be discussed with an attorney if there are several children involved, as well as ex-spouses and remarried spouses. Likewise, trust funds have many rules, depending on the specific type of trust. Tax breaks on investments. Income earned from certain types of investments are treated differently than ordinary income in terms of taxation. There is exempt interest income as well as deferred interest income. Examples of exempt interest income include exempt interest dividends from a mutual fund, municipal bond interest, depending on the state, it might also be exempt from state tax, and private activity bonds. Private activity bonds might be taxable as an alternative minimum tax, AMT, so seek expert advice about this type of bond. Examples of deferred interest income include some U.S. savings bonds, interest earned on tax-deferred accounts, such as 401ks, and traditional IRAs until earnings are withdrawn, and interest income on fixed income instruments, which must be reported when paid upon maturity. College savings. College education in the U.S. has become expensive, and one way to save for this is to start a 529 plan, which is a savings plan operated by a state or educational institution. The goal is to set aside funds to pay for college expenses. It's advisable to start as early as possible so the amount can grow. The earnings in a 529 plan are tax-free, and it will not be taxed when the money is withdrawn to pay for college. Note that the money from the plan must be used for college to be tax-free. Check with the state to find out details regarding funding, tax implications, and the specific type, either prepaid tuition plans or saving plans, of the 529 plan that's available. It's also possible to choose a plan from a state where you don't reside. It's common for close relatives and friends to set up an account for a child. Grandparents often do this to help contribute to their grandchild's college education. Property tax. Property tax is payable on property owned in the U.S. The tax is set by and levied by the governing authority of the jurisdiction where the property is located. According to RealtyTrack's U.S. Property Tax Rates Report for 2014, the average effective property tax rate for single-family homes was 1.29% in 2014. The report showed that owners of high-end homes and owners of low-end homes tend to pay the most property tax rates. Of course, rates also vary by geographic location. States with the highest average property taxes were New York, $15,625, New Jersey, $8,108, New Hampshire, $5,795, Connecticut, $5,646, and Hawaii, $5,024. The lowest were Alabama, $618, West Virginia, $931, New Mexico, $1,096, Tennessee, $1,116, and Indiana, $1,418. Tax on digital currency. Digital currency is money exchanged via the internet. An example is Bitcoin. A digital asset, it isn't printed like paper currency. Bitcoin uses a peer-to-peer payment network. The community of digital currency users is growing. As of August 2013, the value of Bitcoins in circulation exceeded $1.5 billion. Millions of dollars worth of Bitcoins are exchanged daily via the payment network. For federal tax purposes, the IRS treats Bitcoin as property. The general tax principles that apply to property transactions also apply to virtual currency transactions. Inheritance and estate tax. Inheritance tax. In the U.S., inheritance tax is levied by the state. It applies when you inherit money or property from a deceased person. The beneficiary is the one who is deemed responsible for paying the tax. As of 2015, however, only 8 states imposed this tax. There are some exemptions to the inheritance tax rule. Some states exempt the surviving spouse from paying the tax. Children and other dependents may also qualify as exempt, depending on the state. Estate tax. A similar tax is the estate tax. This differs from inheritance tax in a significant way. Estate tax is paid by the estate of the deceased instead of by the beneficiary. There are also thresholds that must be reached before tax is imposed. With estate tax, the heir isn't responsible. The estate pays the tax, which is a flat 40%. Every American has a federal tax exemption amount, which in 2016 was $5.45 million. The 40% tax rate is applied to the amount that exceeds the threshold. The good news is that each spouse gets the threshold amount, so a couple has an exemption of $10.9 million. State taxes might also be due, but it depends on the state and whether there's an estate tax levied there. Most Americans are not affected by estate tax because the threshold values are so high. We hope you have enjoyed this DK audio production of How Money Works, The Facts Explained by DK and read by Wallace Hammond. It was produced by Audio Always, and the post-production was by Audio Always. For more DK audio productions, visit us at dk.com/audio. Thanks for listening. Copyright and recording, DK Audio 2021. Text copyright, Dorling Kindersley, 2021. All rights reserved. The moral rights of the author have been asserted.